G'day there, and welcome to the week ahead on the 7th of March. Boy, things are going ballistic, aren't they? It's pretty nerve-wracking, I've got to say, the way things are moving. I've started today with a chart of the Goldman Sachs Commodity Index. So you're seeing there a chart of, across the board commodities index to give you a sense of the overall moves in hard and soft commodities. And it's pretty clear that things are now going vertical on the back of these huge issues. When we get geopolitical tensions, it's just a situation that these massive moves can turn around just as quickly as they took off if things change on the ground. So it really is not for the faint-hearted trying to trade a market like this. I think you're either in positions and riding the wave and taking some profits and letting things run, or you're standing aside. And I think I've been pretty clear for quite a while of being bullish on oil, bullish on gold, and those things are really flying. Also, the other commodities really taking off as well. I mean, nickel was up 10% on Friday, which is a massive move in itself. So just to show you some individual moves, these are monthly charts. Here's nickel. We've been following the nickel price for a long time, and once it broke out above the highs, it is now accelerating to the upside. Even zinc is flying. Lead, aluminium going vertical. The softs are also going a bit nuts. We've got wheat there really taking off. Obviously Ukraine and Russia, very large suppliers of wheat. Soybeans going through the roof as well. This might be where some opportunities lie if these softs really keep going. Iron ore is also bouncing back after being smashed a while ago, but I reckon that's going to have a use by date, this rally, up around 155. The Chinese property problem is really still bubbling along. More companies of those large developers falling behind on their credit payments. Land sales really dropping through the floor. Prices on blocks of land that haven't been developed dropping through the floor. Rate of sales really getting hammered. So I don't know that iron ore is going to be in strong demand in China as their building boom really turns into a bust. So I'm a bit wary of iron ore. But you can see gold is really taking off now. It's up through all the key levels that I've been discussing with you, and we're now approaching the all-time high. We've got the old high from 2011 there, and we've had this correction after breaking out to a new all-time high. Had a correction for a year and a half or more, and I think the back of that correction has been broken now. I think you have to let gold really go now, see how far it can go. There's obviously going to be lots of resistance on the way up, but it's broken out after spending quite a long time in the bottom half of the range. The midpoint of that range around 1880, and really it's been stuck in the bottom section of that range for a long time. And when that happens, often it can be quick. Once it does bust up through that point of control, it can really blast off, like that Coke bottle getting shaken up. And we're definitely seeing that now. It's being helped along by the geopolitical issues, so you do have to be wary. But I think the fundamentals for gold are there anyway. And look, we've got to start getting a bit concerned now with the way things are moving. Oil taking off like it is. This is West Texas Intermediate, and you'll remember that back in 2008, the peak in oil happened only months before the real crash occurred, the Lehman crash. We're in this situation where oil prices are really spiking. I'd wonder whether it can sustain these levels for long, but it can cause big problems for economies when oil is just taking off like that, especially in an environment with inflation already running at 7.5%. So things are going ballistic, and we're seeing US stocks actually open very weak. So with gold taking off, that's a bit of a risk-off problem. Oil absolutely going ballistic. That's not the sort of inflation you want. And stocks are now reacting. We've got the S&P down 60 points on Monday morning. And overall, that chart not looking fabulous. Last week I was saying to you that the short term looked bullish, and we did see buying, but I said, boy, I'd be very nervous trying to buy that because the longer term picture is bearish. We've got the 20-week moving average, just a very simple thing that I look at. The slope of that's now turning down. I've got the 10-week exponential has broken through there. And, in the past, it's just been a good sign prior to really big moves. Doesn't mean it's a one that I would trade. It's one to say what the momentum is in the market and that there could be more downside coming. When that trend has turned down in the past, there's just been, sometimes long periods of and large sell-offs have occurred once that momentum has turned down. So it's just in that state where you've got to be wary. It's taken a long time to get to this point. It's been months and months of that uptrend. We're not far away from the Fed raising rates. We've got the wars going on, and commodity prices are just going ballistic. I think that is lending weight to people saying, let's just balance up and see what happens here. And as I was saying last week, we've just got a few lines in the sand now. Now we had that spike a few weeks ago, that spike low. I'm a bit wary of what happens underneath that low, which would be the low of the whole move since the all-time high. So the fact that we've got this weekly trend down now, the selling pressure is coming in around that 10-period exponential, which is saying it's quite weak, and it's really looking a bit soggy, opening up down 60 on the Monday. I'm just backing off here and being a bit nervous about what could be coming, and breaking down through those lows, it could go a little pear-shaped. So that's under 4,100 in the S&P. That can end up just being a real stoppy session going on there for a few weeks, and then that could be it. If the market takes the interest rate rise in its stride, the war starts to fix itself up and slow down a bit, maybe that'll be it. But you've got to be aware that that sort of a panicked move, something akin to what happened in the 2020 crash even, probably not as large as that, but still just really quite sustained and heavy selling could happen. So it's a bit of a wild time to be trying to make money in these markets. Those US bonds are really rallying with the yield falling. So this is a chart of the 10-year US bonds yield. So when the yield goes down, that means the price of them is going up. And you can see that with all of this going on, we had the rates rising quite rapidly, and then the war happened, and we've now got quite a bit of buying coming in, and those rates are falling. So just across the market, you're seeing, those signs of risk off and that the market's nervous. Gold really taking off, and bonds really rallying. People are running for cover, and with the stocks opening so weak, I'm wondering whether this week could actually see things open weak and sell off, which is a very rare occurrence. Usually it opens weak and then the buying steps in and all of a sudden it's up. So let's see how this week pans out, but if that selling accelerates in the US, heads down through 4100, I hope you have been heeding my warnings for a while now, and you're prepared for what could be coming, because it's starting to really look ready to get a bit out of control. All right, well, that's it for this week. Exciting times. I'll come back with more next week. Cheers.